Reality Labs has lost more than $60 billion. It has never come close to a profit. And Zuckerberg just announced he will spend $145 billion more. That number deserves a pause. $145 billion in a single year. On infrastructure for a technology that has not yet demonstrated it can generate returns at that scale. The company spending it earns nearly all of its revenue from advertising on 2 apps. There is no second engine. The $46 billion figure in the headline was real. It was the cumulative loss through the early collapse of the metaverse bet, the number that made shareholders furious, that triggered mass layoffs, that forced Zuckerberg onto an earnings call in November 2022 to say something CEOs almost never say. "I got this wrong," he told investors. "I take responsibility for that." Wall Street loved the confession. The stock recovered. The year of efficiency began. 21,000 workers were cut across 2 rounds of layoffs in 2022 and 2023. The market rewarded every step of the retreat. Then the machine kept running. If you subscribe now, you'll be the first to know when the next one drops. Every week. No noise. By the time the metaverse was officially deprioritized, the cumulative loss had already grown past $60 billion. Reality Labs lost $17.7 in 2024 alone on $2.5 billion in revenue. $8 lost for every dollar earned. In Q1 25, it lost another $4.2 billion. Oculus Studios, the content arm of the same division Zuckerberg once called the future of computing, received layoffs that spring. The VP overseeing VR had reportedly told employees internally that newer Quest users simply were not as interested in the product as earlier adopters had been. None of that is the story. The story is what the pivot unlocked. When Zuckerberg announced in January 2025 that Meta would spend $60 to $65 billion on AI capital expenditures that year, analysts treated it as a signal of conviction. By Q1 earnings, the guidance was already raised. By year-end, actual 2025 capex came in at $72.2 billion, roughly 45% of Meta's total 2024 revenue, deployed in 12 months into data centers, servers, and GPUs. Then in April 2026, the company raised its 2026 capex guidance again to between $125 billion and $145 billion. The stock fell more than 6% after hours. An analyst on the earnings call asked directly, "What evidence exists that this level of spending generates sufficient return?" Zuckerberg's answers on record was, "That's a very technical question. That answer is the document." The company spending more on infrastructure in a single year than it spent in the previous 2 years combined cannot yet describe, in plain terms, what return that capital produces. Free cash flow in Q3 2025 fell 31.5% year over year as capex outpaced operational returns. Operating margin compressed from 48% to 41% in Q4 2025. The spending is accelerating. The justification is deferred. Meanwhile, 98.7% of Meta's revenue in 2024 came from advertising. The $60 billion metaverse loss, the $72 billion in 2025 AI infrastructure, the $145 billion plan for 2026, all of it financed by ad clicks on Facebook and Instagram. There is no cloud business generating external AI revenue. There is no enterprise software division. There is no hardware line approaching profitability. There is an ad machine, and there is a belief that the machine will keep growing fast enough to absorb the spend. Technology, retail, and financial services companies account for roughly 55% of that ad revenue. If the advertising market contracts, a recession, a regulatory fracture, a shift in how major brands allocate budgets, the arithmetic behind the AI build-out changes immediately. The company has no backup. In January 2025, a Chinese AI startup called DeepSeek released models that performed comparably to Meta's best work at a fraction of the training cost. Meta reportedly established 4 war rooms to analyze the technology. Internal team leaders worried Llama, Meta's flagship open-source model, would underperform by comparison. Management was described as moving urgently to understand how the cost structure was possible. Zuckerberg's response was to raise the capex guidance. His public statement, "If anything, some of the recent news has only strengthened our conviction. A competitor demonstrated the model could be built for less. The conviction to spend more increased. That is not strategy. That is momentum. The hardware underneath this momentum has its own pressure point." Meta's 1.3 million GPU target for 2025 ran primarily through NVIDIA. H100 GPU rental prices rose 20% in 2026. A100 pricing rose 15%. NVIDIA's chips are manufactured almost entirely in Taiwan. 90% of advanced semiconductors globally are made there. Meta has since committed to a major deal with AMD to begin diversifying. The transition takes years. In the interim, every dollar flowing into Meta's AI build-out passes through a hardware chain with explicit geopolitical concentration. The supplier risk is not theoretical. Cisco built the hardware backbone of the internet boom. Switches, routers, the physical plumbing of the dot-com expansion. Revenue was real, nearly $19 billion in fiscal 2000. Business was growing. Cisco was indispensable. Then the bubble burst and the stock fell 88% from 79 to 950. Revenue barely moved. The business was fine. The valuation carrying the story collapsed. Cisco's stock took 20 years to recover. Not because the technology failed, because the multiple attached to the story could not survive the moment demand normalized. Big tech capex as a percentage of EBITDA is now running between 50 and 70%. At the peak of the telecom bubble in 2000, AT&T's capex to EBITDA ratio was 72%. At the peak of the 2014 energy bubble, Exxon's was 65%. In both cases, the underlying technology was real. Internet infrastructure existed. Shale was real oil. The capital intensity destroyed investor returns regardless. GQG Partners, reviewing this data in September 2025, concludes it simply: companies experiencing this level of capital intensity tend to be structurally poor investments. The fiber overbuild of the 1990s is the starkest version. Telecom companies collectively spent close to $500 billion building infrastructure for internet traffic that was real but overstated. WorldCom, Global Crossing, and Quest raced to meet projected demand that never arrived at the assumed scale. When the carriers collapsed in 2001 and 2002, the shock moved through banks, pension funds, and equipment vendors. More than 20 major telecom companies failed. 4 years after the crash, an estimated 85 to 95% of the fiber that had been laid remained dark. The infrastructure existed. It just wasn't being used. That should be uncomfortable reading in 2026, when the combined AI capex of Google, Amazon, Meta, and Microsoft is estimated at $725 billion, up 77% from $410 billion the year before. If you've made it this far, this channel is what you're looking for. Subscribe before the next one. Most viewers who clicked on this headline are not thinking about their retirement account. They should be. The top 10 stocks in the S&P 500 now represent approximately 41% of total index market value. In 1995, that figure was 29%. In 2015, it was 18%. Meta is among the 9 stocks that collectively represent more than 38% of the index. Anyone holding a standard index fund, VOIVV-SY, a target date retirement vehicle, holds Meta in proportion to its weight. They did not choose to be AI infrastructure investors. The index structure allocated it for them. One analysis published in early 2026 estimated that current S&P 500 concentration levels historically predict forward returns of approximately -5% and volatility above 20%. That analysis may prove wrong, but the mechanism it describes is real. When that much of the market's return depends on that few companies, the index is no longer a diversified cross-section of the economy. It is a leveraged bet on whether a handful of infrastructure plays generate sufficient returns from a technology that is still being built. The 8,000 workers Meta cut in May 2026, roughly 10% of the workforce, were not experimental researchers in a failed VR division. They were operational employees across core business lines. The company simultaneously deployed employee monitoring tools tracking keystrokes and mouse movements. Employee satisfaction ratings on Blind had already fallen 25% from their 2024 peak. The culture rating dropped 39%. The workforce that remained was smaller, under closer surveillance, and carrying the operational weight of a company spending more on capital infrastructure in a single year than most countries spend on defense. Those workers, like most workers, likely hold index funds. The fund they hold is exposed to the company laying them off. The company laying them off is financing the AI that replaces their remaining colleagues. The circle is not poetic, it is structural. The metaverse cost $60 billion and produced an empty world. Zuckerberg admitted the mistake publicly. The market forgave him in weeks. He then announced spending that makes the metaverse look like a rounding error. The AI targeting systems are real. Meta's GEM model reportedly increased ad clicks on Facebook by 3.5 times and improved Instagram conversion rates by more than 1%. Advertising revenue grew to $192 in 2025. The technology is producing measurable results inside the business that actually matters. That is the part the Cisco story clarifies. Cisco's technology worked. The internet was real. The routing infrastructure it built is still in use. The company kept growing for 2 decades after the crash. But investors who bought the stock at the peak in March 2000 waited 25 years to see that price again. The technology surviving the bubble does not mean the stock price survives the repricing. Subscribe and turn on notifications. The next script in this series is already built. The $60 billion metaverse loss is the visible wreckage. The pivot is what made it disappear from the conversation. The AI build-out is 3 times larger, financed by the same single revenue engine, defended by the same logic that the future computing platform justifies the present spending. The CEO cannot yet answer what the return is. The capex is accelerating anyway. The index is concentrated enough that a repricing of these multiples would reach every retirement account in the country. The technology is not the question. AI-optimized advertising works. The recommendation systems work. The targeting improvements are real. Meta's underlying business may compound for another decade. The question is the $145 billion. The question is whether the multiple attached to that spending can survive the moment the market asks, seriously, with numbers, whether the return justifies the capital. Cisco asked that question at $79. The answer arrived at $9.50. The recovery took 20 years. The metaverse was a $60 billion bet on a world that didn't want to exist. The AI build-out may be a bet on technology that genuinely works. That makes it more dangerous, not less, because it means the spending will continue longer, the multiples will stay elevated longer, and the eventual repricing will surprise more people. The technology is real. The $145 billion is the question no one has answered yet.